Did you know there's a single number that determines whether your salary is worth anything next year? It's not inflation, it's not interest rates, and it's not the stock market. It's the number of barrels of oil China buys with US dollars every single day. For the past 50 years, that number has been going up year after year. Billions of dollars flowing into global currency markets as demand for the greenback. It's been the invisible force keeping your dollar strong, your imports cheap, and your government's debt affordable. Now, that number is going down, fast. I'm your host. This is the Stat Guy. And if you don't understand what's happening to China's oil demand, you don't understand what's about to happen to your purchasing power. China imports approximately 11 million barrels of oil every single day. At $100 a barrel where Brent crude was trading just weeks ago, that's $1.1 billion per day that China needs to acquire. In dollars, $1.1 billion every single day. Now pull up a calculator and multiply that by 365 days. That's $401 billion per year in artificial demand for the US dollar, just from China, just from oil. Now ask yourself a simple question. What happens to the dollar when that demand stops? Because it's stopping, right now, in real time, and most people have no idea it's even happening. Here's what makes this moment different from every other dollar collapse prediction you've heard on YouTube. China isn't making announcements. China isn't negotiating. China is simply building alternative infrastructure and using it. Let me take you back to 2018. While American media was obsessed with Trump's trade war, China quietly launched yuan-denominated oil futures on the Shanghai International Energy Exchange, the first oil futures contract outside the dollar system in modern history. Most analysts dismissed it. They said it would never gain traction, that the dollar was too entrenched, that global oil markets would never accept anything else. Those analysts were wrong. By 2023, yuan-settled oil trades represented roughly 20% of China's total oil imports. By early 2025, that number accelerated past 30%. In 2026, we're approaching 40%. China did not build the world's largest yuan oil futures market to leave it unused. They built it because they knew this day was coming. And here's the part that should concern you. This isn't just about oil. To understand why, we need to go back to 1973. In October 1973, the world experienced the OPEC oil crisis. Arab oil-producing countries stopped selling oil to countries supporting Israel in the Yom Kippur War. Oil prices quadrupled overnight. Western economies faced massive shortages. The crisis revealed a terrifying truth to American policymakers. America no longer controlled its own energy supply. And without energy, the economy collapses. So the United States made a deal. In 1974, U.S. Secretary of State Henry Kissinger traveled to Saudi Arabia and negotiated what became known as the Petrodollar system. The deal was simple, and it was brilliant. Saudi Arabia would sell its oil only in U.S. dollars. In return, the U.S. would provide military protection, weapons, and political support to the Saudi regime. Since Saudi Arabia was the largest OPEC producer, the other oil-producing countries had to follow suit. Think about what that means. If every country needs oil, and oil is sold in dollars, then every country needs dollars. Japan needs dollars. Germany needs dollars. India needs dollars. China needs dollars. This creates constant, artificial global demand for the U.S. dollar that has nothing to do with the actual strength of the American economy. That demand gives the United States three superpowers: strong dollar despite deficits, artificially low borrowing rates, the power to destroy any country's economy through sanctions. This is the real source of American power in the 21st century, not the military, not innovation, not democracy, the petrodollar, and China is breaking it. China didn't just create a yuan oil futures market. They built an entire parallel financial infrastructure designed to bypass the dollar system completely. The cross-border interbank payment system CIPS is China's alternative to SWIFT. Currency swap lines with Russia, Brazil, Saudi Arabia, Iran, and dozens of others allow bilateral trade without touching dollars. A shadow network through Malaysia, Singapore, and Vietnam routes the majority of Iran's oil exports in yuan. Russia sells oil to China in yuan. Iran sells oil to China in yuan. Venezuela is negotiating yuan oil sales. And this is the big one. Saudi Arabia is quietly running parallel yuan settlement tracks alongside their dollar tracks. Saudi Arabia, the country that created the petrodollar system in 1974, running yuan oil settlements in 2025. Let that sink in. Markets move before announcements, always. And the silver market has been screaming this at you for the past 12 months. Silver spot is at $75 today. A year ago, it was $31. That's a 142% move. The financial press is calling it a war premium, an inflation hedge, a technical breakout. Those explanations are not wrong, but they are incomplete. What silver is pricing and what it has always priced in before anyone admits it openly is a structural change in the monetary system's foundations. In 1971, Silver was $1.29. President Nixon closed the gold window in August. By 1980, silver hit $50, a 38-fold move. In 2008, the Federal Reserve launched quantitative easing. Silver was under $9. By 2011, it reached $49, a 5-fold move. Each of those moments had one thing in common, a structural change in what backed the dollar. 1971 was the loss of gold backing. 2008 was the acceleration of fiat expansion. 2025 is the beginning of the loss of energy backing. The petrodollar was the dollar's third anchor after Bretton Woods collapsed. China pulling its oil demand out of the dollar system barrel by barrel, day by day. Yuan by yuan is the most significant challenge to that anchor in its 52-year history. As dollar demand erodes, 3 things happen to your life. 1, interest rates rise, because fewer countries are buying U.S. Treasury bonds with their dollar reserves. 2, inflation becomes stickier, because the Federal Reserve's ability to print money without consequences weakens. More money chasing the same goods means higher prices for food, energy, housing. 3, the import subsidy disappears. For 50 years, Americans have enjoyed artificially cheap goods from Asia because those countries needed to hold dollars. As that need decreases, the prices of those goods rise. Your purchasing power declines, not because you're earning less, because the dollar is worth less on the global stage. This is already happening. You felt it at the grocery store, at the gas pump, in your rent or mortgage payment. The gold to silver ratio sits at 63-1 today. During previous precious metals, bull markets 1980, 2011, that ratio compressed to 30-1. At 30-1, with gold at $4,145 where it is today, silver implies $158 an ounce. You do not need to time that move perfectly. You just need to be positioned for it before the mainstream figures out what's happening. China's biggest financial decision of the 21st century is playing out in real time. The stackers who understood it earliest, the people who saw yuan oil futures in 2018 and connected the dots, are already positioned. Tell me in the comments, how much of your portfolio is in physical silver versus paper assets right now? Drop your ratio below. I rate everything. Stack smart, stack physical, stay informed. Black screen. Then, February 24th, 2022, the date appears in cold white on dark background. A financial war is about to begin. The United States and its allies launched the most comprehensive financial warfare campaign in modern history. The target, Russia. The weapon, the US dollar. SWIFT access cut off. $300 billion in Russian central bank reserves frozen. Technology exports banned. Energy imports restricted. Visa and MasterCard suspended. Western corporations ordered to exit. The ruble was expected to collapse within weeks. The Russian economy was projected to contract by 15%, maybe 20%. Some analysts said even more. Vladimir Putin's regime would fall. Russia would capitulate. The West would win without firing a shot. And that was the plan. Here is what actually happened. Russia's GDP contracted 2.1% in 2022, then grew 3.6% in 2023, and expanded further in 2024 and 2025. The ruble stabilized. Russian oil exports continued rerouted through India, through China, through Turkey. Russia did not collapse. Russia adapted. And in adapting, Russia proved something that changes the entire strategic calculus of the global financial system. I'm your host. This is the Stack Guy. And if you don't understand what happened when the dollar weapon failed, you don't understand why silver just hit $75. The dollar's power as a sanctions weapon has always rested on one critical assumption, that there is no alternative, that if America cuts you off from SWIFT, you cannot function in the global economy. That assumption powered 40 years of American foreign policy. Iraq, Iran, Venezuela, North Korea, Syria, all strangled by sanctions, all forced to either capitulate or suffer in isolation. Russia was supposed to be the ultimate proof of that power. If America could break Russia with sanctions, no country would ever challenge the dollar system again. Russia stress-tested that assumption under maximum pressure, and the assumption broke. China settled Russian oil purchases in yuan. India settled Russian oil in rupees. The UAE became a re-export hub. Turkey increased trade with Russia by 87% in 2022 alone. And here's the critical part. The alternative financial infrastructure that China had been quietly building for over a decade, CIPS, bilateral currency swap lines, yuan-denominated commodity contracts, suddenly had a live use case under maximum geopolitical pressure. And it worked. Russia did not defeat the sanctions, but Russia survived them. And survival was enough, because every government on earth was watching. If you're a mid-sized country, Brazil, Turkey, Saudi Arabia, Indonesia, and you just watched Russia absorb the most aggressive dollar weaponization in history and continue functioning, what lesson do you draw? The lesson is not that you should openly confront the United States. That's suicide. The lesson is that you should quietly, carefully build the same alternative plumbing Russia used, just in case. Bilateral currency agreements, yuan reserves alongside dollar reserves, trade relationships denominated in non-dollar currencies, gold purchases to back your currency independently of U.S. approval. This is not speculation. Let me give you the data. In 2021, the yuan's share of global payments was 2.7%. By the end of 2024, it was 4.7%. In 2021, central bank gold purchases were 450 tons. In 2022, after the Russia sanctions, they jumped to 1,082 tons. In 2023, 137 tons. In 2024, over 100 tons, the largest sustained central bank gold buying in recorded history. Who's buying? China, Russia, India, Turkey, Poland, Singapore, the UAE, countries that watched $300 billion in Russian reserves get frozen and decided they needed assets the United States can't confiscate with the stroke of a pen. Gold can't be frozen. Gold can't be sanctioned. Gold doesn't care what the U.S. Treasury thinks. And silver? Silver has always been gold's high beta cousin. When gold moves, silver moves harder. Silver at $75 today, up from $31 a year ago. That is not a war trade. War trades reverse when peace breaks out. The Iran-US ceasefire 2 weeks ago briefly dipped silver and it bounced right back. Because what silver is pricing is not the war. It's the structural lesson the war taught every government on earth. Let me take you back so you understand how we got here, because this didn't start in 2022. This started in 2001. After September 11th, 2001, the United States began using the dollar as a weapon at unprecedented scale. Afghanistan, then Iraq, then Iran, then Venezuela, then Russia. Every time the U.S. used sanctions, it sent a message: obey or suffer. But here's what American policymakers didn't account for. Every time you use a weapon, you give your adversaries a reason to develop a counterweapon. China didn't build CIPS because they love technology. They built it because they watched America freeze Libya's assets in 2011, Iran's in 2012, Venezuela's in 2019, and they realized we could be next. Russia didn't accumulate 200 tons of gold reserves because they're gold bugs. They did it because they watched the U.S. weaponize dollar reserves and decided they needed assets America can't touch. The BRICS nations didn't create a coalition to trade in local currencies because they disliked the dollar. They did it because they watched what happens when you depend entirely on a currency controlled by a foreign power that can weaponize it at will. You cannot weaponize a currency globally and simultaneously expect the world to hold it voluntarily as a reserve. Those two things are incompatible. Every time America uses the dollar as a weapon, it gives every other country one more reason to find an alternative. The Russia sanctions were supposed to be the ultimate demonstration of dollar dominance. Instead, they became the ultimate demonstration that dollar dominance has limits. And the countries that understand those limits are buying gold and silver like their economic sovereignty depends on it, because it does. The Russia sanctions were supposed to be the ultimate demonstration of dollar dominance. Instead, they revealed that dollar dominance has limits. And the discovery of those limits is the most bullish thing that has ever happened for the physical precious metals in your stack. Because now every country knows the dollar weapon has limits. Alternatives exist. It is possible to function outside the dollar system if you prepare in advance. And preparation means gold. It means silver. It means non-dollar trade agreements. It means reducing dependence on a system that can be weaponized against you. The gold-to-silver ratio at 63-1 is telling you the market knows repricing is coming. At the historical reversion level of 30-1, with gold where it is today, silver implies $158 an ounce. The stackers who bought silver at 15 he's $20, $25 understood what was coming. They saw the dollar weaponization. They saw the alternative infrastructure being built. They connected the dots before it was obvious. The question now is, do you see it? Tell me in the comments, do you think the next country to face U.S. sanctions will be more prepared than Russia was? Drop your answer below. Stack smart, stack physical, stay informed.